Hey everyone, welcome back to Tesla Daily. It's April 14th, 2026, and we've got a lot to cover today. First up, we're diving into some intriguing news about the Musk family's crypto holdings. It seems like they've got quite the portfolio, and it raises some interesting questions about the future of digital currencies. Now, let's talk about Tesla's iconic models. We're seeing some of them retire, which is always a bittersweet moment for us fans. These cars have made a huge impact on the industry, and it's hard to say goodbye. But change is part of progress, right? Speaking of bold moves, Amazon is making waves with a new strategy aimed at taking on Starlink. It's a competitive landscape out there, and we'll need to keep an eye on how this plays out. On the Tesla front, we're getting mixed signals about what's next for the company. It's a bit of a roller coaster, but that's the nature of innovation. We're all in this together, navigating the ups and downs. And let's not overlook the inventory crisis Tesla is currently facing. It's a challenge, no doubt, but every company encounters bumps in the road. We believe in Tesla's ability to adapt and overcome. So, stay tuned as we unpack these stories and more. We're in for an exciting ride. In a significant shift for Tesla, production of the iconic Model S and Model X has officially come to an end, marking the close of an era for the electric vehicle pioneer. CEO Elon Musk described this moment as an honorable discharge for the vehicles that helped redefine the automotive landscape and spark mainstream interest in electric cars. The Model S, launched in 2012, has sold nearly 750,000 units over its 14-year lifespan, while the Model X has also enjoyed considerable success despite its complex design features. To commemorate this milestone, Tesla is releasing a limited-run signature series of both models, totaling just 350 units, 250 for the Model S and 100 for the Model X. These exclusive editions feature a striking garnet red paint job, gold accents, and a host of luxury upgrades, including a unique Luxe package that offers lifetime full self-driving capabilities and free supercharging. However, buyers must sign a strict no-resale agreement to prevent scalping, with penalties reaching $50,000 for violations. This move underscores Tesla's commitment to ensuring these final units are cherished by true enthusiasts rather than opportunistic resellers. The Signature Series is invite-only, meaning only select customers will have the opportunity to purchase these final models. The pricing for these limited editions starts at approximately $160,810, including destination fees. As we transition away from the Model S and X, the focus shifts towards Tesla's future innovations, particularly in automation and AI, with projects like the Optimus humanoid robot and the upcoming Cybercab. While the end of production for the Model S and X signifies a pivotal change, it also opens the door for Tesla to concentrate on its more popular models, the Model 3 and Model Y, which dominate sales. As we look ahead, Tesla's strategic pivot towards AI and robotics may redefine its market position, potentially leading to new revenue streams and technological advancements. The legacy of the Model S and X will undoubtedly influence Tesla's future endeavors, as the company continues to innovate in the electric vehicle space and beyond. Tesla Inc., NASDAQ Tesla, is currently facing a significant challenge as its unsold vehicle inventory has skyrocketed to a record high of 164,000 units, raising alarms among investors and analysts alike. This alarming figure comes on the heels of a disappointing first-quarter delivery report, where Tesla managed to deliver only 358,023 vehicles, falling short of the Bloomberg consensus estimate of 372,000 and JP Morgan's projection of 385,000. While this represents a modest 6.3% increase from the previous year, the production side tells a more troubling story. Tesla manufactured 408,386 vehicles during the same period, leading to a surplus of over 50,000 units. JP Morgan Chase & Co. analyst Ryan Brinkman has issued a stark warning, reiterating an underweight rating on Tesla and maintaining a price target of $145, suggesting a staggering 60% decline from current trading levels of approximately $355. Brinkman stated, "The sheer scale of Tesla's unsold vehicle stock has become a primary concern for Wall Street, threatening the company's industry-leading margins and free cash flow. The inventory crisis is compounded by the expiration of the $7,500 federal EV tax credit in late 2025, which many analysts believe pulled demand forward, leaving a vacuum in early 2026. Additionally, Tesla's controversial decision to discontinue the Model S and Model X lines to focus on future robotics has alienated a segment of the luxury market, further contributing to the delivery shortfall. In a contrasting view, UBS has recently dropped its sell rating on Tesla, now seeing a more balanced risk-reward scenario. Analyst Joseph Spack noted, "Our view is balanced by near-term demand challenges, an elevated investment period, and a lofty valuation, weighed against a large long-term physical AI opportunity." As we look ahead, the long-term outlook remains uncertain. While Tesla is pivoting towards emerging technologies like AI and robotics, the immediate pressures on its automotive business could hinder its growth trajectory. The disconnect between the stock's buoyancy, driven by AI optimism, and the core business's struggles indicates that we should remain cautious. The road ahead will require strategic adjustments to address these inventory challenges and restore confidence in Tesla's market position. Now let's shift to the next story. Tesla is currently experiencing a tumultuous period marked by significant sales achievements in the U.S., alongside challenges in international markets and ongoing developments in its AI and robotics sectors. In the first quarter of 2026, Tesla outsold all its competitors in the U.S., capturing a remarkable 54.2% market share, with over 117,300 electric vehicles sold, primarily driven by the Model Y and Model 3. CEO Elon Musk took to social media to highlight this success, stating, "What happened to all the Tesla killers that legacy press and hedge fund short sellers predicted were coming?" However, this positive momentum is tempered by a 16% year-on-year decline in retail sales in China, where Tesla sold 56,107 units in March, down from 74,127 in the same month last year. Analysts are now reassessing Tesla's stock, with mixed ratings emerging in light of a recent sell-off. While some analysts upgraded their ratings, citing the current price drop as a buying opportunity, others remain cautious due to the company's high PE ratio of 337.19 times, indicating elevated market expectations. UBS recently upgraded Tesla's stock from sell to neutral, maintaining a price target of $352. Analyst Joseph Spack noted, Tesla's current levels more evenly balance near-term demand challenges and an elevated investment period against the company's long-term opportunity in physical AI. He emphasized the importance of Tesla's advancements in AI and robotics, particularly the upcoming robotaxi service and the Optimus humanoid robot, which Musk believes could eventually surpass auto sales in significance. Despite these advancements, UBS forecasts that Tesla's vehicle deliveries will remain flat at around 1.6 million units for 2026, with growth projected at a modest 7% CAGR through 2030. This outlook is below broader market expectations, raising concerns about the company's ability to meet investor demands. In summary, while Tesla continues to dominate the U.S. EV market and is making strides in AI and robotics, it faces significant challenges in international sales and production capabilities. The mixed signals from analysts reflect a cautious optimism about Tesla's future, hinging on its ability to navigate these complexities effectively. Here's the next update you should know. In a significant move to bolster its position in the satellite internet market, Amazon has announced its acquisition of Globalstar for approximately $11.6 billion. This deal, which is expected to close in 2027, positions Amazon as a formidable competitor to Elon Musk's Starlink, which currently leads the market with over 10 million active users and more than 10,000 satellites in orbit. Under the terms of the acquisition, Globalstar shareholders will receive either $90 in cash per share or Amazon stock, representing a staggering 117% premium over Globalstar's price from late October. This acquisition not only enhances Amazon's satellite capabilities, but also integrates Apple's emergency messaging services into Amazon's satellite network, known as Amazon Leo. Panos Panay, Amazon's senior vice president, emphasized the strategic importance of this acquisition, stating, "Customers can expect faster, more reliable service in more places, keeping them connected to the people and things that matter most." With plans to launch a direct-to-device D2D service by 2028, Amazon aims to provide cellular connectivity directly to mobile devices, a market currently dominated by SpaceX. Despite the ambitious goals, Amazon's satellite network has faced delays, with only about 200 satellites currently in orbit. The company aims to eventually deploy over 7,700 satellites, but analysts have raised concerns about its ability to catch up with Starlink, which has already established a strong foothold in the market. The competition is heating up as both companies race to provide global connectivity, especially in underserved regions. Amazon's entry into the D2D market could potentially disrupt the current landscape, but it remains to be seen if they can match the speed and efficiency of Starlink's existing infrastructure. As we look to the future, the satellite internet sector is poised for rapid growth, and this acquisition could mark a pivotal moment in the ongoing battle for market share. With major tech companies investing heavily in satellite technology, the next few years will be critical in determining who will lead the charge in global connectivity. Next up, another key development. In a recent revelation, Elon Musk, the father of Tesla and SpaceX founder Elon Musk, disclosed that his sons jointly hold an impressive 23,400 Bitcoin, valued at approximately $1.7 billion. This amount is nearly double the Bitcoin held by Tesla itself, which stands at 11,509 BTC, making the Musk family one of the largest individual holders of Bitcoin globally. Elon Musk emphasized the transformative potential of cryptocurrency, stating, "I have no doubt that crypto will be the future of finance. The old model has run its course. It's finished." He shared his personal experiences with traditional banking, highlighting the difficulties he faces in transferring money internationally, which he finds nearly impossible compared to the instant nature of crypto transactions. This perspective aligns with the growing sentiment around cryptocurrency as a viable alternative to traditional finance, especially for those facing challenges with conventional banking systems. The Musk family's involvement in the crypto space doesn't stop at Bitcoin. They have also engaged with other cryptocurrencies, including Solana. Errol noted, "It was strange for me to receive that payment in crypto," reflecting both curiosity and a recognition of the changing financial landscape. With Tesla's significant investment in Bitcoin and the family's overall exposure to digital assets, the implications for the future of finance and the automotive industry are profound. As Tesla continues to innovate in electric vehicles and energy solutions, the intersection of technology and finance through cryptocurrency could redefine how we perceive value and transactions. As we look ahead, the Musk family's substantial crypto holdings may not only influence their personal fortunes, but could also impact broader market trends and regulatory discussions surrounding digital currencies. The long-term outlook suggests that as crypto adoption grows, companies like Tesla may increasingly integrate these technologies into their business models, further blurring the lines between traditional automotive manufacturing and the emerging digital economy. Now let's shift to the next story. Tesla is currently facing significant challenges in the stock market, with its shares down over 20% this year, making it one of the worst performers among the so-called Magnificent Seven stocks. This decline comes as the electric vehicle, EV maker, contends with increasing competition, particularly from companies like XPeng, which is launching models that closely resemble Tesla's offerings. Reports indicate that XPeng's new Mona LO3 compact SUV is just a few inches shorter than the Model Y, raising concerns about Tesla's market position as it considers developing a more affordable model to compete in this segment. The competition is not just about vehicle design, it extends to technology and performance. XPeng's advanced autonomous driving system has been noted for its next up another key development. In a significant legal development, the NAACP has filed a federal lawsuit against Elon Musk's artificial intelligence company, XAI, accusing it of violating the Clean Air Act due to the operation of unpermitted methane gas turbines in South Haven, Mississippi. The lawsuit, filed in the U.S. District Court for the Northern District of Mississippi, alleges that xAI has been using these turbines to power its data centers, including the massive Colossus facilities, without the necessary permits or regard for the health of nearby residents. According to the lawsuit, xAI installed and operated 27 gas turbines, each comparable in size to a large bus, between August and December 2025. These turbines are said to emit harmful pollutants, including nitrogen oxides and particulate. And that wraps up our update for today. Thank you for tuning in to Tesla Daily Insights. We appreciate your support and enthusiasm. I look forward to catching up with you in our next update. Until then, take care.